Queensland government has pledged to double the power bill rebate to $1,000, meaning most people won't need to pay anything for power in the July quarter. Now, the plan will cost the state $2.5 billion and won't even be means tested. Let's bring in macro business chief economist Leith Van Onselen now. Leith, good to see you as always. This comes just before October's state election. I mean, it smells like desperation to me, but do you think that this is indeed financially responsible?
Look, I do actually, Danica. You might be surprised to hear that. These rebates have been paid for by the 2022 budget decision to basically increase coal royalties. So it's not borrowed money. It's effectively money that's come from the mining sector. And I view it as effectively a dividend back to Queensland households for their mineral wealth, right? So they own the resources. They're basically getting a return on those resources from this record export boom that we've had. Now, the rebate should also be reduce inflation, because previous rounds of energy rebates, the Australian Bureau of Statistics has shown have actually lowered energy prices by about 10%. Those are the energy prices that feed in the CPI. So they will actually help to also lower inflation. So I think it's a tick in two boxes. That being said, it really is a band-aid to cover over the really high energy costs that Queenslanders and indeed Australians are experiencing. And what we really need is longer-term energy policy to actually bring down energy prices. And I think what the Queensland government should be doing is copying Western Australia and reserving some of its export gas for domestic use. It should also put price caps on that gas to keep gas and electricity prices lower. And it should also consider imposing higher royalties on the gas sector so that Queensland households receive a bigger return from their mineral wealth, because at the moment they're not earning enough.
Yeah, OK, well, look, that's certainly then positive news. Now, Leith, concerns over another interest rate hike are back, of course, after last week's disappointing inflation data that showed it hadn't declined as much as forecast. But with retail sales also being extremely weak, some, like yourself, don't necessarily think that the RBA's next move is to hit the cash rate button. Why?
Yeah, so you might recall we talked, I think, a week ago, Danica, and all the talk then was about, this higher than expected inflation figure, which could potentially lead to, another rate hike from the RBA. I think this week's retail sales have actually put a dampener on that. Now, retail sales unexpectedly fell by 0.4% in March, and they're up only 0.8% year on year. Now, you might be listening to that thinking, oh, that's still growth. They're actually the weakest annual retail sales since 2000. If outside the pandemic, so that's almost 25 years. And also, once you subtract population growth of about 2.5% and CPI inflation of 3.6%, what it means is that households effectively cut back on their retail spending by about 5% in the year to March. That's a massive cutback. And this decline in expenditure makes sense when you consider the fact that Australian households experienced the biggest decline in household disposable income in the world last year. So they suffered basically a 6% decline in real household disposable income. And what this basically tells you is that household consumption is incredibly weak. That drives about 60% of the economy. And that should be a flashing red light signal to the Reserve Bank that doesn't need to hike rates again, because households are already cutting back hard on expenditure and the economy's in trouble, basically.
Yeah, it certainly seems that way. Leith Van Onselen, great to speak with you as always. Thanks for joining us on the show this evening.